Hey, good evening, everyone. I'm Frank Angelos. I'm the managing partner here at CNA Financial Group. We're in the fourth quarter, and it's our pleasure to be with you this Wisdom Wednesday. It's kind of been an interesting year. We've had, you know, the press going with regard to, everything that's been going on from tariffs and AI and everything else under the sun. And so it's our pleasure this evening to bring a special guest to you. I'd like to introduce you to Dr. David Marshall, Senior Investment Specialist and Strategist over at State Street. And so, David, it's a pleasure to have you with us today. Thanks for joining us.
Thank you. I appreciate it. Thank you for inviting me.
So, David, you can't turn on the news or pick up a paper or turn on the radio or whatever without there's a different headline every time we turn around. It's been a interesting, crazy year. And, believe it or not, here we are at we're in the fourth quarter. Um, Things have been looking pretty good so far, and everybody's waiting kind of for the shoe to drop. Is it going to go higher? Are we going backwards? Where are we going? And by the way, none of us have a crystal ball. We don't know what it's going to do. But there's a lot that's taken place, and it started with the tariffs, um, and it went from tariffs to being a concern. Then we hear about all the promises and the opportunity of AI. And then we had, government shutdown. And so, in light of all that that's going on, I mean, State Street being such a prestige, investment management firm, and with your background and your expertise, David, what are some of your thoughts on what you're seeing, and how would you look at this at this point?
Yeah, so it's a great question. I think every time we say it's been a unique year, we really think it's a truly unique year, and maybe it is one today. The reality is this: is that we've gone through some very, very considerable volatility. I think I've measured the volatility of volatility recently, and I've basically figured out that we're probably about in the 80th percentile or greater relative to history. So significant volatility has been upon us. Now, as it relates to our expectations, at least at this present time, believe it or not, we are relatively optimistic at this present time. We came in the year with an overweight to equities of about 4%. Believe it or not, post Liberation Day, we've only added to that equity exposure in sequential fashion. And right now, we are about 11% overweight equities at this present time. So that should be somewhat of an indication of at least our partial confidence in the marketplace. Now, that does not mean that risks are not abound. There's plenty of risks. And I know that I've heard from many of the naysayers talking about recession is in our midst. At this present time, we are not forecasting a recession. We recognize recession is a possibility, but it is not our best forecast. It's not the median of the distribution, so to speak. We are still expecting a soft landing. A soft landing can be characterized as a time period whereby growth might be less than long term average, i.e., 3%, but maybe a little bit higher than 0%, if you will. So softer than usual is our expectation. Now, furthermore, we do acknowledge that the economy is downshifting, and we've seen that through some of the job numbers that have come through as of late. Now, I think it's through about, for the summer period, through August. Unfortunately, job growth was not too robust. I think we averaged about 29,000 jobs per month, which is a lot lower than the historical record. In fact, the normal the normal way to kind of understand job growth is that anything between probably 150 to 200 is probably about average and probably means that the economy is still expanding. But we've gotten significantly less jobs than that. Now, some people have raised concerns that that is probably indicative of a weaker economy. We definitely agree with that. But just to give you a contrarian opinion or something else to think about at least, we've all heard about AI as you mentioned in your question. AI is definitely having an impact on the economy, probably in a positive way. Positive, I guess, in terms of how you interpret it, but positive from the standpoint that potentially our economy is running more efficiently, i.e., needing fewer jobs to actually maintain that equilibrium amount of growth. So that would actually say that maybe that 150 to 200 number is a little lower than expected. However, I think we could all say that an average of 29,000 jobs per month is probably a lot lower than average, and we're probably in the downshift mode. So that is why also we do anticipate the Fed to lower rates in the tune of about 50 basis points for the next two periods. So the Fed does meet in October and it does meet in December. So each of those periods, we do expect the Fed to lower by 25 basis points. Now, we do acknowledge there could be this possibility for an additional 50 basis point cut for one of those meetings, which would put us at an effective, I guess, three cuts, if you will, of 25 basis points. The other thing to contend with, too, is this dual dynamic, which is obviously consistent with the Fed's way of looking at the economy of growth versus inflation. So, on the growth side of things, we expect things to be a little weaker. On the inflation side of things, there's a little bit of concern, but growth seems to be a little bit more of a greater concern to us. Um, Inflation has actually come up since the beginning of the year. If you look at things like food inflation specifically, sequentially, that has increased every month this year. And it's actually increased more towards the latter periods of the year. I want to say that food came in at increased by 3.2% in 1 month, which is a huge increase for a month over month increase. The interesting part about inflation, however, is though certain components might be a little bit troublesome, more specifically, I think it's household equipment, it's and food items, and some other items that are somewhat troublesome. There are several other items that are mitigating its effects. So that comes down to shelter, rentals, and even energy to some degree. So inflation, an issue, but potentially not as big of an issue because of other components that are weighing it down. So we do anticipate inflation to probably increase towards year end to close to 2.9% would probably be our expectation by year end. Um, and some of that is, as we would acknowledge, is due to some of the tariffs that have recently started to they started to be passed on to consumers effectively. So the reason we've had some delay in terms of these prices being felt by consumers is due to the fact that in the first quarter we had high inventories, and so producers had to sell off those inventories that came pre-liberation day, pre-tariff. And then secondly, we have delayed effects. Obviously, anytime you buy new inventory, it takes time before those new inventories make their way overseas to the US shores. Then we have the delayed effects of the numbers being reported. So any effects that we see, it takes a month for those effects to happen. And then we also have these delayed effects from basically how businesses perceive or treat higher tariffs. Historically speaking, when higher tariffs affect businesses, the first thing they try to do is look for efficiencies in their operations so that they don't have to raise prices. So they'll look to cut certain places, make operations more efficient, reduce their pricing structure before passing those higher tariffs on to consumers. So effectively, they're eating those tariffs at that present time. But we know that businesses are profit seeking enterprises. So at some given period of time, they have to then seek to pass those costs off to consumers to maintain their historical profit margins. And that is actually what we're starting to see, and that's what's kind of forecasted. In fact, earlier in this tariff period, if you will, let's just say for sake of an argument here, about 70% businesses were eating those tariffs. That is expected to flip, according to analysis by some sell side firms, in the month of October specifically. And so we won't see the results of that until next month because of the lag in reporting, and maybe even longer than that because of the shutdown scenario that we're dealing with today. So to just round out, I guess, some of these thoughts in terms of what we're seeing today, we're seeing an environment that is plagued with a lot of volatility. However, we still see some opportunity, even though growth is going to be weaker. Now we're not expecting growth like we saw in 2020, 2024, but it's a more muted growth. That's why we're overweight. We're actually overweight plus 11% at this present time, which is our highest overweight for this year. Um, Inflation is going to be sticky, but it's going to go up slow. We expect, obviously, for other components to kind of weigh that inflation down. I think other things that are kind of supporting this growth story, at least at this present time, I mean, from historical precedent, the fourth quarter does tend to be a better quarter on average, too, going by historical precedent. I think the number is 70% of the time we end up in the green for the fourth quarter. Then we're starting to also see support, obviously, from other things. I think CEO confidence survey came out, which indicated that CEOs actually have more confidence now at this present time. So that's another positive sign. There's some deregulation that came in the big beautiful bill, I guess, that is somewhat positive. So more deregulation is helpful for businesses in terms of them maintaining profits. There's also in the bill, there was some abilities for certain businesses to write off certain expenditures or to accelerate the depreciation of certain goods, which would also, help them to increase their profits. So we like that story as well. And then, of course, having the Fed lower interest rates could be helpful to businesses in general. So, relatively attractive environment. We run a tactical portfolio. Clearly, we can change the complexion of that strategy or how it's positioned in a short period of time.
So, David, just a couple of things is, when we speak in terms of a couple of rate cuts coming in, through the course of, the next, couple of months. So, we're here, kind of middle of October-ish. Um, from a bond standpoint, because many portfolios are 60/40s and there's the 40 bond or 80/20, the 20% bond.
Yeah.
How are you viewing the bond side? Are you going more intermediate terms on bonds? Are they going a little bit longer term in anticipation of the lower rates? What are you seeing on that side? And then I'll ask you a little bit about, if you don't mind, stock valuations, because
Yeah.
it does seem a little pricey out there on some of the stock side. So, thoughts on, rates and a little bit on valuations.
Yeah, another excellent question. So in our framework, obviously we invest in equities, fixed income, and commodities. And for a good portion of the year, it's been either equities look good, real looks good, or fixed income looks good, or more attractive, I should say. So in this period, believe it or not, a number of these major asset classes actually look pretty attractive. Thus, are overweight. I mean, we have a good overweight in commodities right now, half represented by gold, half represented by commodities. But within fixed income, we recognize that things are becoming more attractive. So we run several fixed income models which help us to understand valuation as well as its general attractiveness. And so what we kind of notice is that rates at this time are more likely to mean revert. And so that's one of the positive signs that we see. We also see, some weakness, which is also suggestive of some lower rates. And then we see the curve, the longer end of the curve as well, in terms of the slope specifically. We see some moderation with the curve. And so if you look at some of our recent trades, you'll see that we changed the duration profile of our portfolio a little bit. We did get a little bit longer due to some of these effects that we predicted. And so we put some money in our fixed income sector rotation, which is a aggregate bond type of position, but rotates amongst various fixed income sectors. So we increased the duration. Also, the prospect of lower rates does improve the attractiveness of some credit securities. So credit continues to look attractive to us, but high yield still being an overweight at this present time, but a little less attractive than they had previously. And that's why we move, more of our weight towards, more of that intermediate, part of the curve. In general, too, is um, when volatility decreases, credit also looks more attractive. And so post Liberation Day, we had considerable volatility, but believe it or not, on a relative basis, even though we're still dealing with significant volatility, relative volatility for this year in particular is a little lower. And as a result, that's also providing a little bit of tailwind to credit in general. So that speaks to credit. Now, as it relates to valuations, you are right to talk about valuations. Valuations are a little bit of a concern. If you look at the valuation for the S&P today, it is definitely high and higher than historical standards. So the question becomes, whether or not, a tactical portfolio uses that as a very strong signal to figure out how to allocate assets. So the reality is that valuation is one of the many components that we use to direct portfolio assets, but it's not the only one. The reality is that things like momentum, sentiment, macro are going to have more of an impact in terms of the returns of assets in the short to intermediate term. Valuation is a longer term signal, and it tends to actually work best over 5 and 10 year periods. However, all else equal, though, when you have high valuations, it can be also a risk proxy, meaning if you have high valuations and let's just say low sentiment, that could be a recipe for disaster because both of those things are moving in a downward direction. However, what we see is this high valuation in the presence of good sentiment. So that's basically analysts saying, hey, we see some opportunity in stocks and we're starting to upgrade these in math. So that's a good indicator. Momentum. So we see momentum in the marketplace, which is just simply looking at securities going up in price effectively. So we see that as a more positive indicator. And the macro environment has also been a little bit more constructive. We actually will map different asset classes across the world in this macro context, where we look at securities and how they do in different parts of the macroeconomic cycle. And this part of the macroeconomic cycle, the U.S. tends to reign supreme. So, with that said, even though valuations are a little higher, macro is still, pretty constructive. So, all else equal, sure, valuation is problematic, but it's only one of many components that we look at.
Very good. So as I listen to you, David, sounds still optimistic as far as, and how you're seeing things. The fact that, State Street and, you being, senior investment strategist with them are still, long, equities and overweight. Um, as an advisor and, for, sitting here dealing with clients and teaching other advisors, for the time being, I'm feeling pretty good about what I'm hearing and what I'm seeing. And again, nobody has a crystal ball, but and by the way, every time something happens, it's always different this time, but there's always a different thing that occurs. But the market still works its way through it year
Absolutely.
after year.
Absolutely.
Very good. So David, I'd like to, thank you for being with us today. For all of our guests who's listening in, you've been listening to Dr. David Marshall, Senior Investment Strategist over at State Street. And David, we appreciate you. We appreciate your input, your partnership. And I know that you've got, one of our specialists on the line there, Enoch Chang, who's been, a great supporter, working with us as well and with our clients. And so with that being said, I wish you a great holiday season as we're going through, Halloween and everything else and Thanksgiving. And we'll be circling back at year end just to see how the year's finishing up. So for all of our listeners, enjoy, as we're getting into Halloween and the holidays, and we'll catch you next month. Thank you.